All right. Today is Tuesday, November 1st. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And let's start by this. I hope everybody had a great Halloween and you enjoyed the inflated prices in candy. And if your kids did some trick-or-treating and they scored a bunch of Skittles, you're sitting on a gold mine. Give them a tap on the back, a tip, something. Because now you can sell all of that Skittles and retire. You don't even need to watch this show anymore. Because the prices of Skittles up 2% year over year. We're going to talk more about inflation, but before we do that, let's talk market here because the equities market was blasting higher in the morning, and the reason is we got another piece of fake news saying that the Chinese are planning to end the thing zero policy, and immediately Chinese equities shot up higher and the US market shot up higher with it in optimism that the draconian lockdowns in China will be over, let's say, soon. And here's the problem. Unless it's coming from Xi Jinping and he says, okay, I'm done with the lockdown lunacy, I don't believe it. I think this is yet another pump and dump scheme. But we know at the end of the day that this is a market that is dominating by the Federal Reserve and the monetary policy. So throughout the day, the stock market lost the gains and closed at the lows of the day, in the red. Why did that happen? Before I tell you why, all eyes are going to be on the FOMC, the Federal Reserve Chairman Powell tomorrow. And the market is heading into this meeting with the assumption that the Fed is going to pivot. The pivot is in the bag 100%. He's going to do 75 and then he's going to announce 50 or 25 in the next meeting. And folks, I'm telling you, this is the consensus among everybody in the financial community. Every portfolio manager, every hedge fund manager, all the analysts and strategists, they're all saying that the Fed is going to do the 75 tomorrow, then announce the pivot of a 50, if not less, in December. And I've been telling them, hey, as the last scene in The Wolf of Wall Street, sell me this pen, sell me the pivot. Tell me why. What piece of data merits the pivot right now? And they'll bring out some weakness in the economy, some bullshit piece of data, which I can counter easily using 10 pieces of data. And when I push and push and push, they finally say, hey, this is the consensus. Everybody says that the Fed will do 75 and then 50 and maybe 25. So we have the phenomenon of group think here. They're all like a bunch of sheepies saying, hey, the other guy says the pivot is going to happen tomorrow. The other guy is positioned that the pivot is going to happen tomorrow. I don't want to miss out. Maybe they know something that I don't. And then the next guy does the same, and the other guy, and the other gal. And all of a sudden we have a financial community that is all in the pivot. Matter of fact, they're getting so arrogant right now to the point that they're saying maybe tomorrow the Fed will announce a 50 basis points hike, not a 75. The pivot will happen as soon as tomorrow, and the stock market is going to blast by 10% in a single day. What the hell are these people smoking? I look at the ECB, for example, as a guideline. If you say that the Fed has to pivot because we have economic weakness here in the United States, whatever economic weakness we got here pales in comparison to the economic weakness taking place in Europe right now. Despite all of that, the ECB came out with a 75 basis hike, and the delusional madwoman, Madame Lagarde, said that she's going to continue to raise rates even if there is a risk of a recession. So why would the Fed do anything different here than the ECB? You can say, oh, the Bank of Canada went down, the Bank of Zimbabwe went down. But at the end of the day, the ECB, the second largest central bank, says they're not going to waver. They're going to continue to push on until inflation goes down, even at the risk of a recession. And today we got a wake-up call, a piece of data to all of these pivoters that, hey, time to wake up from these fantasies. And perhaps it was the reason, not perhaps, we know it was the reason behind the downturn that we got in the equities market today. And this piece of data is job openings, JOLTS. They surged higher again. And the chairman of the Fed last time around made it clear that he's not going to pivot. He's not going to slow down the rate of hikes until we see softening in the jobs market. And this piece of data says we're not even close. And it's not just about the jobs market. It's also inflation and many other indicators that don't merit a pivot at all. We're going to go over all of them and a lot more in tonight's discussion. So without further ado, here it is. In focus tonight. The pivot fantasy. And we start with Jerome Powell's own words from the last meeting. Take a look.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
So notice that I highlighted for you the three conditions that he gave. Number one, a slowdown in growth. Number two, softening of the jobs market. Number three, inflation heading down to 2%. Let's take them one by one. When we talk about growth, we got the GDP data last time around, and in Q3, the GDP was positive. So is this a slowdown in growth when the GDP is moving higher? On top of that, the underlying conditions, the tailwinds for growth and inflation remain intact. And the moment the Fed takes their foot off the accelerator in terms of tightening rates, we will see these tailwinds kicking right away in form of aggregate demand, and inflation will surge higher like you have never seen before. It would be a mistake the likes of the 1970s Arthur Burns style. Now the chairman says he wants to be Volcker, not Burns. Consumer spending contributed to higher GDP. People still have jobs. People still have inflated wages. People are still using their credit cards, swiping them up and down, up and down. And if the Fed says, okay, we're done with the tightening, let's go back and party, you will see housing prices pushing higher again. You will see the consumer splurging again. You will see inflation popping higher again in a way that we have never even imagined. Uber CEO came out today and said, we're not seeing any sign of consumer weakness. They continue to jack up prices higher and higher and higher. It costs an arm and a leg to take an Uber ride these days, but the consumer continues to pay because they still have a source of income. Yes, they're getting squeezed by higher inflation in grocery, fuel, utility bills, rents, but they're still able at this stage for now to continue to stimulate the economy. The only thing that will slow them down is more Fed tightening. So the Fed moving away from tightening by pivoting, this will allow inflation to shoot up higher again. No doubt about it. On top of that, today we got construction spending and it was up by almost 11% year on year. So when JP says he's going to pivot if he sees a slowdown in growth, we are definitely not seeing this in construction spending. Now you might say, hey Maverick, but what about the manufacturing PMIs, for example? The headline readings, the pace of economic activity is slowing down in contraction territory, in recessionary territory. And oh, by the way, prices paid are also going down. Isn't it time for the Fed to slow down the pace of interest rate hikes? My counter would be, what about the Chicago PMI that we got earlier this week? The headline reading was down in contraction, in recessionary reading, yet prices paid continue to move higher. In other words, we have stagflation in the economy. Certain pockets are slowing down. Certain pockets are in contraction territory. That's for sure. But there are other corners in the economy that have yet to slow down. On the other hand, all in all, we're seeing prices moving higher across the board. There are exceptions here and there, but for the most part, prices are moving higher. So when you have the Fed sending mixed signals that they're going to tighten, they're going to be tough on inflation, they're 100% committed to take inflation down, and then they pivot prematurely, what do you think will happen here? Growth will accelerate higher again? although it's going to lag the pace of growth in inflation. And this is the problem here. Then the Fed has to come back, catch up, and be even more aggressive in tightening the monetary policy, which will produce more damage to the economy. Now, the second condition that JP outlined is a softening in the jobs market. What did we get today? Job openings surged higher to 10.7 million postings. In other words, the jobs market remains tight, the jobs market remains hot, and thus wage inflation remains hot. So if you say this is the time for the Fed to ease down and pivot and slow down the pace of rate hikes, once again, what the hell are you smoking? Job openings are moving higher again. Even this nitwit from the Journal, Nick Tamaris, he says the number of job openings in September rose by 437,000 to 10.7 million, and the August figure was revised up by 200,000. The Fed would like to see the ratio of vacancies to unemployed workers decline, and it ticked up in September to 1.86 from 1.68. Again, does this merit a pivot right now? When it comes to the third condition that JP outlined, which is inflation heading to 2%. Last week, we got the PCE inflation report, which the Fed looks closely at. The report showed that wages are rising rapidly in the third quarter. Wage inflation is not slowing down. The headline reading of the PCE went higher, 6.2% in September. Core PCE went higher by a half a percentage point month over month. And you're saying the job is done right now? That's it? Enough? Look at the CPI. And this is the month over month reading. We know year over year, the numbers are way too high and the base impacts will slow them down alone. But we look at month over month to see the trend and where it's going. We will look at the headline CPI. Sure, it went down to 0 in July, and since then, it has been trending higher again. It never even went negative throughout the year. And you're saying job done, it's over, time to pivot? What are you talking about? We'll look at the core CPI, still not going down, still producing substantial gains month over month. We'll look at apparel. Okay, this is down, this is trending down. So there is some progress here. The month over month readings in apparel are going down. How about energy? Sure, it slowed down and went down by 4.6% in July, and another 5% in August, but then in September, it moved up higher again to minus 2.1, and the assumption here is in the next reading it's going to be positive again. Just look at the commodities futures and the gains from September to October. So sure, energy inflation went down negative, but it is trending higher again. You think this is the time for the Fed to back off? You want to see energy inflation moving higher month over month again, scoring gains of 3, 4, 5% growth month over month? Because that's what's going to happen. What about food? Still not going down, still going higher month over month. Medical care services. The inflation here is actually accelerating and moving higher month over month. How about new vehicles? Still not going down substantially. Used cars and trucks. This is going down. And we have indicators from the Manheim Index that indicates that used cars prices are going down dramatically. So here we're seeing some progress. What about shelter? That's not moving down. Continues to move higher. What about transportation? It went down in July, but it popped higher again in August. And it's moving in a positive trend again. So to summarize all of this, when it comes to the CPI, we have apparel, energy, and used cars trending down, but we have sticky inflation in the headline CPI, in the core CPI, in food inflation, in new vehicles inflation, in transportation inflation, and then we have categories actually trending higher, be it medical services or shelter. Now you might say, hey Maverick, but shelter is lagging. Rents are actually going down. Now here's what JP said about the lag last time around. Take a listen.
Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that.
So A, he acknowledges the lag. B, he acknowledges that at some point they're going to slow down the pace of interest rate hikes. But he gave you the condition for that. This condition is financial conditions. And he wants to see financial conditions being tight because it takes financial conditions being tight for a while before we see that translating into the real economy. The strategy here is get it tight and hold. But every time the stock market rallies higher, financial conditions loosen, and thus it works against the Fed. In essence, it is fighting the Fed. We look at the Chicago National Financial Conditions Index. And by the way, this reading is even before the recent rally in the stock market. You can see that financial conditions are curling down. They're loosening again. My assumption is when we get the update of the recent stock market rally, you will see that financial conditions loosened even more. Now, do you really think that Jerome Powell is going to come out tomorrow and say, sure, yeah, we're going to pivot. Stock market, please go higher again. So financial conditions can loosen and we undo all of this work that we've done so far in fighting inflation. Do you really think he's going to do that? I say think again. And if that was not clear enough, the reporter presses again. When are you going to slow down the interest rate hikes? Listen to what Jerome Powell said.
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
And of course, JP's joking and laughing here because he knows what they're aiming at. These reporters are working on behalf of the oligarchs, the Wall Streeters, the hedge fund managers, and they want to know when the Fed is going to pivot. They want to know when the market is going to go higher. They want the Fed chairman to slip and give them something that this is the time to buy. And therefore, Jerome Powell says, I know better not to answer his second question because I know what you're aiming for. Continuing.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
So he says there is a ways to go. The strategy is clear. Look, I'm a critic of Jerome Powell, but last meeting he was crystal clear of what the strategy is. The strategy is raise interest rates to the point where it becomes restrictive to the economy and it pushes inflation down. And of course, it's going to come with the cost of a major slowdown in the economy, even higher unemployment. But the Fed has to raise rates all the way to this restrictive level and then hold, meaning they're going to slow down at some point and then hold and see what the impact is. But notice that he also said that after the last meeting, after the last rate hike, they just got to the lower level to what that restrictive rate is. So you think another 75 will get us to the higher end of that restrictive level right away? I doubt it. And if that was not enough, here comes Nick Timiraos again and hammering down Jerome Powell on what this restrictive rate looks like. Take a look.
Nick Timiraos at the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive, and by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
So Jerome Powell identifies the rate as number one, putting downward pressure on inflation. With the rate that we have right now, and with the rate that is already priced in the economy and in the market, the CPI remains way too hot. The core CPI remains way too hot. Even PCE and core PCE, they remain way above the Fed's target of 2%. And there is no indicator at all that these are heading down to 2% right now. Look at the futures. Look at commodities. They're moving higher again. Every time the dollar goes down, commodities surge higher again. That in itself tells you that we're not seeing downward pressure on inflation. If anything, the market remains like a cocaine addict, itching and waiting for any sign that the Fed is going to back off. And once that happens and the dollar goes down, inflation and commodities move significantly higher right away. The stock market shoots up higher right away, loosening financial conditions. So we're not at the restrictive rate yet. We're not even close. And then he identifies the restrictive rate as something that pushes yields across the curve. And we're talking real yields to positive territory. We know right now if you use the inflation rate and the yields across the curve, the real rate remains negative. And we know from history that to tackle inflation, you need to push real rates to positive territory. In other words, you need to push the federal funds rate above the rate of inflation. But of course, they're not going to do that right now. He says in calculating the real interest rate, don't use the current inflation rate. Instead, use future expectations of what the inflation rate is going to be. Okay, let's play that game. We will look at the University of Michigan Consumer Sentiment Index. Inflation expectations ticked higher again. And even after the 75, if they do that tomorrow, real rates will remain negative because inflation expectations continue to move higher. In summary, if the Fed indeed announces a pivot tomorrow, it will be the beginning of hyperinflation in the global economy. We might see energy prices reaching 110 by the end of the year, and it will be a major mistake, something on par with the 1970s and even transitory. On the other hand, if the Fed doesn't pivot and it actually doubles down and says, hey, we're not seeing anything here, any progress here that merits a slowdown in the rate of hikes, and they come out hawkish, we will see the stock market going down and the June bottom is not going to hold by the end of the year. But in all likelihood, Jerome Powell is going to thread the needle by leaving the door open for all possibilities. He's going to try. He's going to try to do that. Now the reporters are going to push him in hope that he's going to slip and say something. So we're going to see how careful he's going to be tomorrow. But folks, let's be honest here. The stock market right now is heading into this with the coke addict mentality, meaning the market is going to tone out any hawkish talk by the Fed. They're not going to even listen. Their ears, the market ears, will be laser focused on any hint of a pivot, even if it is a slip, even if it is not legitimate, even if it is just on the dot plots that certain Fed members are indeed thinking about slowing down the rate of hikes. This is what the market is concentrated on 100%. They're looking for it. They're itching for it. They're positioned ahead of time for it. So the risk remains to the upside. However, if the market fails to get anything from the Fed that hints or signals that a pivot is coming, that a slowdown in rate hikes is coming, and we see consensus among Fed members and the chairman himself that the fight is not done yet, and they will do whatever it needs to be done to tackle inflation down, even if it means another giant rate hike in December. If that is the case, the market is going to suffer a massive withdrawal here. So this is the setup before the FOMC tomorrow. And with that being said, let's move on to cover the stock market information for you. We begin with the closing of the indices today. And here we go. The Dow Industrial Average down by 79.75 points or a decline of 0.24%. The Nasdaq down by 97.30 points or a decline of 0.89%. The S&P down by 15.88 points or a decline of 0.41%. All of these indices were in the green big time at the open, and then came the meltdown all the way till the end of the day. When it comes to the sector's performances, at number 1, capturing the gold medal, materials. Number 2 for the silver, energy. Number 3 for the bronze, financials. Meanwhile, the laggards of the day, communication services, cyclicals, and technology. It was a risk-on kind of day, but it was a risk-on using commodities. Not tech, not cyclicals, not the communication services. Matter of fact, we got massive down days in names like Amazon. We'll talk about that in the heat map analysis, but here's the advance to decline ratios. NYSE 59% advancing versus 40% declining. The NASDAQ 54% advancing versus 43% declining. When it comes to commodities, the winner of the day was crude oil futures, be it the WTI or Brent, all up for the day by about 2% apiece. Now, we talked about China in the beginning and the rumors that we might see a liftoff in the lockdowns, and that contributed to oil futures moving higher. But perhaps the number one contributor, and we're going to keep an eye on this story here because it might push crude oil futures to above 100 in no time. We have report from Saudi Arabia that there is an imminent Iranian invasion of the kingdom. Now, if that happens, oil will shoot up higher to above 100 easy. But the question now becomes, we have a, let's say, damaged relationship with Saudi Arabia, specifically because of the Biden administration. So how's that going to play out? If Iran invades Saudi, will the Biden administration get involved in this case? Because remember this, the U.S. cannot really fight Russia face to face, because that would escalate to a nuclear war. But the US can fight its proxies, Russia's proxies. And Iran is not really a Russia proxy, but it is supplying Russia with drones and a lot of weapons. And the US wants to hit Russia somehow without being directly involved. So is it going to be a war against Iran that starts with the invasion of Saudi Arabia? Oh boy, we haven't seen anything yet. But back to the futures. While the gasoline RBOB scored gains of about 2.75%, heating oil was down by about 1.5%, and the party boy not partying today, natural gas erasing the majority of the gains from yesterday, down about 8% for the day. So what happened here? Why the 180? Why the U-turn? What took place? Remember, the reason behind the shoot up higher in natural gas yesterday was the weather outlook. And I told you this season we're going to be Al Roker, all of us, looking at the weather and the predictions and the outlook, the forecast to trade natural gas. But I also told you the forecast is going to change based on the polls, not the weather polls, but the political polls. Yesterday we get the forecast that we're going to see a colder winter. Natural gas shoots up higher by 10%. And the implications are the consumer is going to pay more comes this winter in utility bills to cook, to heat their homes, etc., etc. And today we get an update, and the update says, oh, never mind, the forecast was wrong. We now have models that show that the winter season is going to be actually a lot warmer than we said yesterday, and natural gas goes down. And folks, after the midterms, all of these forecasts are going to be revised, all of these numbers will be revised, and you're going to see the reality. And when the reality sets in, you realize that you're going to freeze your nuts this winter. But we have a lot of tailwinds for natural gas to shoot up higher. Among them, number one, Freeport LNG is about to restore at least loading cargoes again this month. We also have Japan being worried about the supply of natural gas. And they're not talking about this season. They're talking about 2023. So we know that the tailwinds for demand are still here. They're going to be here with us all the way till 2023. And I view the pullbacks in natural gas as an opportunity to buy. Now, let's talk about crude for a little bit because the president is floating a windfall tax on U.S. companies, Exxon, Chevron, etc. Today in the morning, we got the report from Aramco, Saudi Aramco, that they scored profits of over $42 billion in the last quarter. Once again, $42 billion, not in revenue, in profits. Meanwhile, we have an administration here that wants to punish U.S. oil and gas companies by imposing a windfall tax and leave them at disadvantage against Saudi, Chinese, and Russian oil companies. Does this make sense to anybody, regardless of your political allegiance? Does this make sense to anybody at all? I don't think so. And yes, the oil companies are producing massive dividends, massive buybacks. As an energy investor, you know that. It's been a good year. But the reason why they're kicking back all of these profits to the investors is what are they going to do with the money? If the administration is so hostile to the oil and gas industry and effectively it has a death warrant against oil and gas, what is the point of investing? What is the point of using that cash to produce more supplies, to build on more pipelines, more refineries, more infrastructure. What is the point of doing all of that when you know they want to kill your business 10 years from now? So for now, oil and gas is pretty much, let's use the opportunity, pump these prices as high as we can, produce as much cash as we can, and return that cash to the investors until the commodity dies. Back to the futures. What about softs? What's going on here? We have a rebound, a big one for cotton, worth about a little over 4% for the day. And then we have sugar also advancing by a little over 2.25%, a more modest gains for both cocoa and OJ futures. On the other hand, coffee is declining again, with losses of about 1.5%, and then lumber down modestly, losing about 1% for the day. Now, while the dollar was higher, it was down big initially, but then it rebounded higher when we got the jolts. But despite that, it was a good day for metals, silver, platinum, copper, palladium, all shooting up higher with gains of over 2.5% for the most part. But look at what gold is doing. The old man, the mature guy in the room, is not trusting this rally. The old man is saying, watch out, the dollar might pop higher again. We'll talk more about that in the charts analysis, but before we do that, what about meats? Live and feeder cattle futures are down modestly, and then we have modest gains for lean hogs futures, nothing notable here. When it comes to grains, once again, major gains across the board, led by, this time around, rough rice. Do yourself a favor and pull up a chart of rough rice. This thing is shooting up higher, and today it scored gains of about 4%. And then we have yet another day worth of gains for wheat, about 2% or so. Likewise, the same goes for oats and soybeans, and then we have more modest gains for corn, less than 1% for the day. On the other hand, we have modest declines to flattish activities for soybean meal, soybean oil, and canola futures. Moving on to the big casino, the options market. What's going on here? The calm before the storm. The volume is slowly but surely going down. We're seeing still more buying of calls than puts. The optimism is still here, but it's being toned down. And at number one, the hottest table by far, was Amazon at around 1.2 million contracts traded today. About 60% of those were calls. And at number two, Apple with around 860,000 contracts traded today. About 57% of those were calls. And at number three, Tesla, the souffle, with around 720,000 contracts traded today. About 55.5% of those were calls. I'd keep an eye on Meta, because look at Meta. About 500,000 contracts traded today, but about 72% of the spread was actually for calls. A lot of folks are doing bottom fishing, I should say. I'm doing the same, but I'm doing it carefully, and I discussed how I'm going to do it in last night's video. If Mark capitulates, if the government bans TikTok, all of these are good tailwinds for the name to shoot up higher in a short covering rally. And it's going to be a big one. I don't want to miss it. I don't know when it's going to happen, but we know it's going to happen at some point, because the trajectory that Zuckerberg is in is not sustainable. If he continues with the metaverse lunacy, at some point, the stock is going to crash all the way down to the IPO price. At some point, whether he likes it or not, he has to capitulate. In the meantime, moving on to the unusual activities that took place in the options market today. We start with the ticker QQQ, the Nasdaq. Somebody's betting that the reversal that we got today is the beginning of something, and they bought the 240 puts for the expiration date December 2nd, with expectations that the name could move down and lose more than 13% of its value by then. And they paid around $1.20 a piece to enter this trade, all in all spending around $2.4 million. And then what about the IWM, the Russell 2000, the outperformer so far? But somebody sees this outperformer coming down too. And they bought the 153 puts for the expiration date January 20, with expectations that the name could move down or lose more than 16.5% of its value by then. They paid around $1.70 a piece to enter this trade, all in all spending around $1.3 million. And lastly, what about the ticker GOOG? Google was down big today, and somebody sees more declines to come. They bought the 85 puts for the expiration date November 11, with expectations that the name could move down and lose more than 6% of its value by then. They paid around 70 cents a piece to enter this trade, all in all spending around $450,000. On to the heat map. What's going on here? The weakness in big caps continues. Amazon down over 5.5% in a single day. Google down over 4%. Microsoft, Apple all down. Meta is the outlier here, closing in the green with gains of a little over 2%. We talked about the rumor that we might see a ban on TikTok. They float these once in a while, and it plays good for Meta and Snapchat and all of these names. But then we have some earnings movers. Look at Intuit in software, INTU, down big, over 7% for the day. On the other hand, we got another reporter from Pfizer. Of course, Pfizer is swimming in cash. No wonder why the stock is up over 3% for the day. And then we have the Chinese names Alibaba, JD shooting up higher based on the rumor that, hey, the Chinese authorities might slow down or get rid of the lockdowns altogether. I say for now, every pop in Chinese stocks is an opportunity to sell, opportunity to short, until Xi Jinping comes out and says, no more, we're not doing the lockdowns anymore. Absent of that, I cannot trust any rumors floating online. We gotta see an official statement by Chinese authorities saying we're gonna change our stance in the lockdowns policy. And frankly speaking, you don't have to chase the Chinese stocks because you got a lot of good stocks around, all of these value stocks. But look at energy, for example. The majority of names are in the green. The refiners especially moved significantly higher today. We talked about some of them not so long ago in this program, and I floated the names VLO Valero and MPC Marathon Petroleum. Both of these are shooting up significantly higher. Now, when it comes to EQT, natural gas, it pulled back today. But remember, it scored gains of over 8% yesterday alone. For now, energy remains bullish until Chairman Powell comes out and says, I'm going to be a super hawk, no pivot, we're going to double down. And then the dollar shoots up higher. That would be bad for energy. But even if that happens, the tailwinds remain super strong for energy. So sure, the Fed can be as hawkish as they can. Let's say if these lift-off of lockdowns in China rumors are true, that is one massive tailwind to push energy prices higher. For now, yours truly is overweight energy, be it in Oxy, be it in Devon, be it in SLB, be it in Marathon, be it in Valero, be it in EQT, be it in Coterra. The majority of my longs are in energy right now. When we look at the heat map for the ETFs, again, flattish. The majority of the gains are coming from commodities, ETFs, energy, XOP, XLE. The OIH was flattish today, but again, even gold miners, GDX, silver, SLV were all in the green. The majority of the gains are led by commodities. Once again, value outperforming growth. Look at the contrast between the IWD and IWF, for example. Sure, value is on the flat line, but flat is good in a down day like this. When it comes to international ETFs, Chinese ETFs are rebounding higher, FXI, MCHI, and this is pushing emerging market ETFs. EEM shot up higher today. But the problem is all of these pops are transitory without a solid official confirmation that the lockdowns are behind us. Absent of that, all of these ETFs will move down again in no time. In the meantime, let's cover some charts here and then wrap it up. And we start with SPY, the S&P 500, 30-minute chart. Yesterday, we talked about a bear flag consolidation pattern at around the support of 385.15. Today, we got a gap higher instead, but the gap higher turned out to be a gap and crap. We have yet another one, a bear flag consolidation pattern at around the same support, now resistance at around 385.15. And a reminder, you're not going to be super bearish right now until the support of 373.5 is broken. Absent of that, despite the declines that we got today, the bulls remain in charge. Because here's the daily chart for the continuous contract for the S&P. Notice no harm done, no damage done today. Even the support of 3,855 remains intact. Nothing happened today. The volume below average, the momentum indicators remain positive. The bulls are in charge. We need to see a loss of support of 3,855, but most importantly 3,720.5, and then we're talking. And a lot of you, by the way, the new viewers of the channel say, hey Maverick, why too bearish? Why are you hoping that the chart would go down? I'm not hoping for anything. I'm just saying the opportunity right now isn't trading puts, not calls, because the calls are really, really expensive. The premiums are out of whack. On the other hand, the VIX is down, puts are cheap, so the opportunity here in trading perspective, from a trading perspective, I should say, is for the market to go down and playing it via puts. What about the Qs? Here it is again, another bear flag and a failure of cracking above 280. And if this bear flag plays out, we go down to the June bottom, 269.29. But remember, the bulls remain in charge until the June bottom is gone again. And for now, this has yet to happen. The reason is, when we look at the daily chart for the continuous contract, the reverse head and shoulder formation remains intact. And it's not going to go bust until we see the June bottom being violated. And the June bottom stands at 11,058.5. For now, the volume is below average. The momentum indicators remain bullish. Nothing to see here. What about the IWM? The Russell 2000, 30 minutes chart, what's going on here? It is still outperforming. While the SPY and the Qs went down, IWM still holding on the support of 183.25. And for now, the resistance becomes 188. But is this the beginning of a reverse ABC pattern in which the IWM loses the support of 183.25 and it goes down, something to think about. I think this outperformance by the Russell 2000 is fugazi. In other words, it's a fake out. And sooner or later, we're going to see the Russell playing catch-up with the NASDAQ, not the other way around. And here it is, King Dollar. What's going on here? It was down big initially at the beginning of the day. Then came the jolts, and the dollar shot up higher. But it remains below the resistance at around 111.5. The MACD indicator remains negative. The RSI still in negative divergence. For now, dollar bears, equities bulls are in charge. But are dollar bulls / equity bears closing in? The answer is yes. And they might, keyword might, score a decisive victory tomorrow if Jerome Powell comes out with the hawkish rhetoric. We'll see what happens. But for now, the most accurate indicator for the dollar, gold, is not showing us that the dollar is about to go down. Gold did not even cross above 1,671, despite the recent decline in the dollar. As if gold is saying, I don't trust the move in the dollar. Maybe I will if Jerome Powell comes out with a pivot. But until then, this could be yet another instance where Tricky Dixie is playing possum again. And then what about the daily chart for Brent oil? What's going on here? On track for the ABC pattern, but boy, is it running out of time or what? We know what the tailwinds are. China lifting the lockdowns, the imminent invasion of Saudi Arabia, if that's true, I don't know. But the headwind is if the Fed comes out hawkish. And now it becomes a game of balances. Are the tailwinds stronger than the headwinds or the other way around? In my calculus, right now, the tailwinds remain more powerful than the headwinds. And the reason is the Fed remains behind the curve. The Fed is not raising rates to the restrictive level yet, and therefore, for now, the tailwinds have the advantage. And this ABC pattern might play out. We'll see what happens tomorrow. In the meantime, here it is, yields, the daily chart, what's going on? A lot of assumptions that yields already topped. I caution against that because if you switch to a daily chart, and by the way, we discussed the bearish scenario in details. The bear flag, which is not forming so far, but most importantly, the head and shoulder formation. We talked about that, in last night's video? 2 videos ago? So let's talk about the bullish scenario here. We switch to a line chart, and as you can see, the chart is forming higher highs and higher lows. And if this trend continues, the 10-year will make a higher high. Could be even higher than 420. In the meantime, what about the TLT, a daily chart? What's going on here? Which ABC is winning right now? The answer is, so far, the bullish ABC. But folks, it all depends on JP, what he's going to say tomorrow. So we can't even say anything here. The technicals don't matter. It's all about the Fed. What about the VIX? Watch out here. It appears that the VIX is bottoming. This is a 4-hour chart. Look at the MACD indicator showing us green impressions in the histogram, the beginning of a bullish momentum. The RSI is in positive divergence now, indicating that the bottom is here in the VIX. You put 2 and 2 together. If the VIX is bottoming, it's about to pop higher. What would be the catalyst? The answer is, how about JP coming out hawkish? No pivot, folks. Joke's on you. And then what about Apple? 15 minutes chart. What's going on here? We got a bear flag yesterday. Another one today, and I said that Apple is parking illegally above 150, and the tow truck will be here in no time, and this gap at 145 will be closed. No doubt about it. Here's Tesla, 30 minutes chart. What's going on here? We got a gap and crap, another bear flag formation, forming a lower low in the trend line that we talked about yesterday. But for now, it remains trading above 224.29, or 39 I should say. So for now, we have one confirmation. The trend line is broken. The chart is making a lower low, but we don't have the most important confirmation, which is the loss of support at 224.39. And I would be even more conservative and say the loss of support at 217.88. Otherwise, I'm going to hold on buying puts here. And here is the daily chart for Tesla. We identified some resistance zones before. It passed zone number 1. Now we're at zone number 2. And it appears that the chart is facing some resistance here. We don't have a confirmation that this is a reversal yet, but that could happen as soon as tomorrow. So keep an eye on the daily chart of Tesla. How about BTC, tulips? What's going on here? No update. The bears have their theory of a double top. The bulls have the theory of, hey, it's a trend line, higher lows. What are you talking about here? The chart is above 20,000. This is bullish, not bearish. For now, who has the advantage? The answer is the bulls, not the bears. So long as the chart is trading above 20,000, the bulls have the advantage. The bears will have the advantage if the chart says goodbye to 20,000 once and for all. But until that happens, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the ADP employment report. This will be important. And then rental vacancy rate, another important indicator. But again, all eyes would be on the FOMC and the chairman of the Fed, Criminal Powell. Whatever he's going to spew, whatever he's going to vomit, this is what the market is really tuned on to. Anyhow, once again, folks, thank you for your support. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will definitely talk to you again tomorrow. Take care.
We found something. A chance, maybe.
So,
Found what?
don't give me hope.